Hello, and welcome to Foist & Gordon & Payne's mid-year webcast. My name is Mimi Majumder, and I am a Principal Client Relationship and Business Development Manager at FGP. I will be your moderator as we talk to a panel of our portfolio managers on a retrospective of the first half of this year and their outlook for the remainder of 2026. Joining me to share their insights today are three members of our investment team. Cameron Greenwood, our Senior Vice President, Fixed Income Portfolio Manager and Co-Chair of our FGP Investment Committee. Brian Pillsworth, President and CEO and Head of Canadian Equities. And Andrew Aucoin, Senior Vice President, Portfolio Manager and Head of Global Equities. It seems like it was another lifetime when we recorded our beginning year review in January. So much has happened over the course of the last 6 months. And I'll make a note that FGP also had a milestone in that we have moved back into our remodeled and refreshed offices here at 1 Adelaide Street East in Toronto, from which we are recording today's webcast. As we are recording this webcast on Wednesday, July 22nd, I think it's safe to say that there may be still a few surprises yet to come before this year is over. In preparing for this recording, I went back and looked at some of our webcasts from the past, and the one word that came back over and over was uncertainty. We live in uncertain times, and it's very possible that we wake up in the morning and find that the world order has changed. And it's within this environment that our portfolio managers are managing their strategies. So to begin our discussion, I'll turn to our first panelist, Cam Greenwood, our investment committee co-chair. Cam, I don't think we could have a discussion about the first half of 2026 without addressing the war in the Middle East. Can you help us to understand what were the immediate shocks after February 28th, and how have things played out since?
Yeah, thanks, Mimi. Like you said, it's been an interesting start to this calendar year. When I think about it, the immediate shock really was kind of a classic geopolitical shock we see roll through financial markets, right? So oil prices spiked higher immediately. Inflation expectations increased. Bond yields were relatively volatile. A lot of people started thinking about the need of central banks to change their policy rates to account for the shock. Risk assets like equities and corporate credit and preferred share markets, they also came under relatively significant pressure in Q1, varying degrees, but definitely some pressure in Q1. Underpinning all these moves really was this idea that the energy shock of this magnitude, or an energy shock of this magnitude, would usher in this economic environment, characterized by much higher inflation and much lower economic growth. Thankfully, as we move through the second quarter, cooler heads prevail to a certain extent. And we've seen a lot of those initial reactions reverse. Oil prices, they remain very volatile, even up to including today, but they have come off their peaks. The inflation scare has moderated, and the markets have refocused on resilient economic growth and strong corporate earnings. I think both Brian and Andrew will probably talk in their coming answers. This allowed equity markets to generate really strong returns again in the second quarter. I think the broad takeaway for the first half of the year really is, even though that initial market reaction was significant, the economic impact has been far more contained than what most people feared at the beginning of the year.
Okay, so then to follow up on that question, has this changed? Has what's happened and that tempering, if you will, in Q2, has that changed your outlook for the second half of the year? And also, I guess to add to that question is, were there trends that were latent or that have accelerated due to what happened in the first half of the year?
Yeah, I think fundamentally, no, it hasn't changed our long-term outlook. But I'd agree with that last part. It has had an impact on trends we saw developing before the conflict. I think, if anything, really, the conflict in the Middle East has served as a good reminder just how quickly geopolitical events can reinforce, underlying inflation pressures, but also spread uncertainty to nearly every corner of financial markets very, very quickly.
Well, you just said the word uncertainty. And so, if I can play on that for a moment. And you mentioned inflation. You talked about central bank policy. So where are we? I mean, is there uncertainty in looking forward to that?
Bigger picture, we continue to move away from the post-financial crisis environment of ultra low interest rates and, abundant liquidity in financial markets. And we're moving into this world where inflation is likely to be a little bit stickier. Central bank policy is likely to be a little bit higher, and economic growth is likely to be a little bit lower, although still positive. From an investment perspective, that has some implications. I think investors can no longer rely simply on falling bond yields to raise the prices of financial assets. So I think forward returns are going to be generated much more based on things like valuations and fundamentals and security selection. I think that's true for equities. Maybe these guys correct me if I'm wrong, but it's certainly true for fixed income.
That's a perfect segue because I'm going to ask you to put on your fixed income portfolio manager hat. And let's talk a little bit about credit spreads. So we're coming out of a period where we've seen historically very, very tight credit spreads. Mm-hmm. Are there any segments of the corporate structure in the bond market that portfolio managers like yourself are actually finding that they're being rewarded for taking on that risk?
Credit spreads are tight, but I don't think we're out of that environment just quite yet. We're still living through that. And just speaking broadly in terms of compensation, I don't think investors are being compensated fairly for adding additional credit risk to their portfolios in today's world. That would be my first point. I think, though, if I step back and look at the fixed income asset class as a whole, there is a real advantage. And that is all-in yields, the difference or the combination of your benchmark yield and your corporate spread remains quite attractive. And that has an impact because it allows investors really not to step too far down the risk spectrum to generate what's relatively compelling income from their investment portfolio. One more quick point before I give these guys a chance to talk here. When we're talking about credit spreads, they are tight. And in these periods, there's the temptation to reach for that additional bit of spread in what could be a riskier opportunity. I think I'd remind investors, the goal should more be towards the generation of risk-adjusted returns rather than just hitting absolute yield numbers, right? So if you think about that additional 10, 15, or 30 basis points on offer in that risk opportunity, that might not seem like such a good deal when you take into account the downside risk that you're assuming to earn that extra yield.
And that's something you're doing every day when looking at that portfolio is looking at that risk.
That's the goal, yep.
Wonderful. Thank you, Cam. We're going to circle back to you. But since we've talked a little bit about macro events, I'm actually going to turn it to the two equity managers now. And a question that I'll pose to each of you every week seems to bring a new headline, whether that's geopolitical tensions, whether that's trade negotiations, tariffs, central bank policies, new prime ministers. Let me ask the question to you. How are you thinking about macro events? And how are you, if you are, incorporating that into your investment decision making?
Yeah, as you mentioned earlier in our first webinar, we talked about the uncertainty, and there's just been a deluge of more macro events that create this uncertainty. And when I think about macro events, though, I think of two buckets: noise versus signal, or noise versus fundamentals. And it's really key that you identify what that event is. So I'm just going to give you an example. I'm going to go back a little while to Liberation Day, which happened last year. And that created a lot of uncertainty and stocks were negative. One of our companies, which is in the automotive sector, did react negatively prior to that event and leading into that event. And you would assume that based on the macro events and all the discussion that you probably wouldn't want to own an auto parts company. So that's what I would call noise. Now, let me talk about the signal or the fundamental. So this particular company, despite this noise, managed to increase their earnings, improve their margins, and generally the fundamentals had improved. And as a result, the shares of this particular company reacted to the fundamentals. So you have to be very, very careful to conflate macro news to your investment thesis. Now, I am going to give you one example of where macro events that impact a fundamental observable input, which is a lot of techno jargon. And the oil situation, I think, is a good one that Cam talked about. We had this recent event. It's still ongoing in the world right now, and that event has changed oil prices. Oil prices were kind of muted, and then they went up, and then they came back down, and they've gone back up. Nonetheless, we can see what's happening in the oil market. We can see what's happening to supply. It is information that we can put together. So we can put together information that is more measurable. And as a result, we can say, okay, well, what do we think the new price of oil long-term is going to be? That thinking goes into our investment thesis and goes into how we look at the companies. And it's not to say that oil prices are going to be high forever. That's not what we're saying. But what we are saying is maybe oil prices should be a little bit higher on a go-forward basis because, frankly, there's been a massive disruption in the world, and we can see it. We can see how many ships are going through the Strait of Hormuz, and it's not that many. And so that's kind of an example of a macro event that drives a fundamental input into the modeling that we do for our energy companies, and that one is more important. So again, noise versus signal or noise versus fundamentals, I think that's our framework that we look at for investing.
I'm going to take that next beat to pose the same question back to Andrew. And are you thinking about macro events? Are you incorporating them?
Everything we're doing from a research perspective really starts bottom up with the companies. But a key part of that is the companies we're looking to invest in, we want to be resilient across a variety of scenarios. And so we're trying to find companies that, regardless of what the macro is going to throw at it, they're going to be able to grow and continue to generate cash that they can return to us over time. And so I'd say that's really the thing. And so one of the things in that we think about is the pricing power of the companies that we're investing in, because as Cam has sort of alluded to, and Brian, inflation is probably something that's a little bit stickier today than it was in the past decade. And so we want companies that can offset that cost inflation that they're going to see by being able to have some pricing power within their business. Certainly, we're thinking about the macro, but it's really from that bottom up, looking at each individual company and how they can sort of operate in an environment that is obviously going to be uncertain.
So really, that's looking at management and the company the ability of that company to be all weather in many ways. What has driven returns year to date in your portfolio specifically? And what are we doing differently than others?
When our investment strategy starts with, as Andrew just said, bottom up. So we're looking for high quality companies with earnings that we can understand and are growing, and we're looking for valuations that aren't demanding. And so when you look at, I'm going to talk more in general terms, but when you look at the companies that have done well of late in the portfolio, these are companies that are growing their earnings. They're demonstrating that, and their multiples are also expanding. So I think on an individual security selection, that's really, really key. We're trying to, at the portfolio level, be different from the index, right? In order to beat the benchmark, you have to be different from the benchmark. And you have to be willing to do that. So it's really, I would say very, very strong security selection with the drivers of earnings expansion and multiple expansion. And then I would say it's also having a portfolio that is differentiated from the benchmark. And while you cited energy and financials, and categorically those have been drivers, we've had other sectors. It's not just kind of two stories. We've had other sectors that have driven, I'll call it alpha or positive attribution in the portfolio in other sectors as well, such as industrial, such as consumer discretionary, such as consumer staples. So it's really not just those two sectors. It's broader than that. When we talk about, our strategy and our philosophy, it's really to own high quality companies that generate higher returns on equity at lower valuations than the index. And that is the cornerstone of our philosophy and our approach. And we believe if we maintain that approach, that drives outperformance. So we're always looking at our portfolio relative to the index to ensure that it is higher quality, better returns, ideally lower leverage relative to the benchmark and a lower valuation. And that still remains the case today, which is positive for future expectations.
And would you say it's fair to say that we actually stick to that knitting over time and we do that cycle over cycle?
Absolutely. I mean, that is something we practice what we preach, and we aim to maintain that positioning. That is our philosophy. That is our cornerstone. I will add one small caveat. I will say that, the markets have been very strong, perhaps a little stronger than I expected, but a number of the sectors have companies that are growing their earnings. And so the price increases that you see in particular securities is being driven by earnings growth. It's not just kind of a multiple expansion story, which I think is quite important.
Thank you so much for that insight into the Canadian market and the strategy itself. I'm actually going to turn now to Andrew, looking a little bit more broadly at the global markets. So we continue to live in a time that is just fueled by the AI enthusiasm, and call it mega cap, call it large cap companies that are just leading the charge in terms of that concentration of return. Let me ask the question to you of how are you managing your portfolio against this backdrop? And when you consider the companies that are really sort of at the forefront are those that are building out in the AI infrastructure. How are you using that theme in your portfolio?
It certainly takes up a lot of our time and attention thinking about the impact AI is having on the whole market and the whole economy and the businesses we own. First off, from a portfolio perspective, we want to maintain a diversified portfolio across a number of businesses that have different drivers. Increasingly, we're seeing the market get extremely narrowly focused around one theme, which is AI and the build out of the AI infrastructure, which is certainly something that some of our companies benefit from. But we also have other companies that have less to do with this and that have more what we think of as more resilient earnings and more resilient businesses. A lot of this is a one-time build out of the infrastructure. A lot of companies are benefiting from that, but there's a lot of spend right now by a concentrated number of companies. And up until this point, it's a lot of the companies you'd think about that have significant free cash flow from other businesses within their portfolio. But we're reaching a point today that they're spending all of that free cash flow on an infrastructure build out of data centers. And as we think about going forward, the expectations are that continues to grow. And that likely comes from them having to take out other forms of capital and raise capital to sort of support that further growth of a data center build out. So that would be equity, which we've seen a couple equity raises already this year, and that would also be debt raises, which we've also seen, but increasingly are likely to support the incremental build out. If you think about just our philosophy and what we've talked about, one of the things we look for is less leverage. And now we're talking about adding leverage to a business or into an industry, which just inherently makes it more risky, right? And so if we think about the top level of this industry, the business models are still being developed, and yet there's a lot of capital that increasingly is likely to be funded by leverage that is building that. And so there's just inherently more risk, and it's less predictable. It's not to say it's not going to drive significant growth for these companies. It absolutely has the potential to, but it just carries a lot more risk. And if you think about to Brian's point before of what we're looking for high quality businesses that generate higher returns and that are trading at more attractive values than the market. And we also want those businesses, we want to understand those earnings and where those earnings are come from and have an understanding of, like we talked to before about the macro uncertainty, just how these businesses react in different environments. And for a lot of that AI build out, it's still unclear. It's very early. It's very exciting. The technology is unbelievable, but it doesn't sort of completely mesh with the philosophy we have around investing, which is more predictable businesses with more resilient earnings profiles that generate cash and that need less of that cash to continue to grow their business so they can return it to their shareholders. These businesses increasingly require more capital. Mm-hmm. That's just sort of how we think about that within the context of what we're doing is we're really looking for businesses that are going to be extremely durable and that we can count on for cash for us as investors.
So let me I'll dive a little bit deeper into that question around if the risk water level, if you will, is increasing. Are you seeing or do you anticipate that trickling into your portfolio, or are you very clear about maintaining the risk level of your portfolio?
If anything, if we see incremental risks associated with a business, we're likely to reduce exposure to that, right? And that's always, again, in the context of valuation We are extremely valuation focused. And so if this part of the market is also has a lot of excitement around it and valuations are rising, that's also something that we're then looking to find things that are more attractively valued.
Excellent. Thank you very much for that, Andrew.
Yeah.
It's good insight. This is the fun question. I get to ask the question to each one of the panelists now. One of the hallmarks of successful investing is always being able to update your views. And as the world is changing, we're talking about a time of uncertainty. We need to update our views. So over the past year, what's something you've become either more optimistic or more pessimistic or more cautious about, and what drove that change? So is there a view that you've updated to make you either more optimistic or more cautious? What caused that? And I'm going to start with Cam.
For me, it's relatively straightforward. From a big picture perspective, over the last couple of quarters, I've become more optimistic about the resiliency of economic growth. I think, as we came into 2026, there was this broad acceptance that growth was going to slow. That was going to allow policymakers to reduce their rates, or make rate cuts. And it just hasn't played out like that. The economy, specifically the U.S. economy, has been supported by a very strong labor market, healthy consumer spending, and a lot of that AI CapEx that Andrew was just mentioning. For me, it's given me more confidence that we're returning to a more normal investment environment where we're probably going to see more dispersion of returns across regions, across sectors, across individual investment. And I think that's actually really good news for long-term investors because it makes, disciplined, active investment more valuable than it's been in many, many years.
All right, let's go to Brian.
My turn.
Please.
I'm mindful of valuations. I mean, there has been valuation expansion across indices. There's, some things that have really expanded in valuation and some things that have lagged. So I think we should be mindful of when an individual security is trading well above its normal historical high valuation. So I think that, and we're seeing more examples of that. Our portfolio is positioned to be better than the index on valuation. So things are moving quite a lot and have moved a lot. So I think that's something to be mindful of. The second thing I would say in terms of maybe a little bit more conviction, I think the energy sector in Canada, we've always been deep investors in this sector, and we understand it very, very well. But I would say there's two things that have happened. Obviously we talked about the war and the supply situation. I think that's one. But the other thing I would mention is that Canada and our governments have reached agreements to support and expand the industry. And I think that's very, very positive, both from the ingress, egress, in other words, pipelines, and also from the stimulating production growth. And so these are early days in these things. So you can't bank on them just yet, but I think they're incredibly positive for long-term investments in the sector. So that's where we would be, I would say, more positive.
I'm hearing words like optimism and positive. This is great. Andrew?
I think I'll take a slightly different tack. So still staying on the optimist side, but just if we circle back to what we've been talking about before, about maybe some caution around incremental risks with AI spending, quite optimistic about the capabilities of the AI itself and just, how that can improve efficiency for our businesses, even for our process ourselves. We see it on a daily basis. So really optimistic on the benefits we can get from the technology.
Thank you for sharing these candid insights. I think it's always useful for folks to hear how you're thinking as you go through your days. In the last few minutes of our webcast, we're going to shake things up a little bit. We're going to do something we haven't done before, which is a lightning round of questions. So the folks here don't know what questions I'm going to ask them. They'll have one word or maybe about 5 seconds to answer each, 5 to 10 seconds to answer each question. So I'm just going to kick it off. Here we go. Rapid fire. Brian. One word to describe today's market.
Strong and positive.
Andrew, what's one risk you think investors are underestimating?
We've talked about just the leverage that potentially comes into the system going forward.
Cam, if you could only follow one economic indicator, what would it be?
Probably inflation. It's a bit of a cop-out answer.
All right, we'll keep moving forward. Andrew, what's one opportunity you think investors are overlooking?
Some of the valuation opportunities outside of the AI theme that we've talked about.
Brian, what's more valuable right now, patience or conviction?
Can I say both?
Yeah, I think so. We'll go with both. And Brian, I'm going to stay with you. Finish this sentence. Successful investing requires.
Discipline.
And a final question. We'll start with Andrew on this one. If you could have coffee with one investor, past or present, who would it be?
I'd actually probably say Don Foyston.
Excellent response. Let's actually go to Cam next. Cam, who would you have coffee with?
I'm going to need a couple words for this. I'll give you a personal answer. Past or present, I'd have coffee with my grandfather. He's taught me a lot. He taught me really never to assume that I knew everything, always dig a little deeper, always stay humble. And I think as I've gotten older, I realized just how important that is, not only in investments, but, also in life. So that would be my answer.
Very good advice from your grandfather. Excellent. Brian.
Oh gosh, the bar's been set very, very high. There's a value investor that I learned about when I was much younger, John Templeton. He was one of the original value investors, and if he was alive today, that would be someone I'd love to sit down and have a coffee with.
Thank you so much for these insights. Your candid responses are always interesting, both for myself and hopefully for our viewing audience. So thank you again for your time today. And with that, we will draw our webcast to a close today. Thank you so much to our viewing audience, and we hope that you found this discussion to be insightful. As a reminder, these webcasts are a great way for us to connect with our supporters from coast to coast across the country, but they are no substitute for the one-on-one conversations. To that end, please don't hesitate to reach out to myself or another member of our client relationship management team to set up time for a more in-depth discussion. So on behalf of all of us at FGP, we wish you a wonderful summer and a wonderful rest of 2026. Thank you.